Right now, SoFi Technologies, trading under the ticker SOFI, is at $28.25, which is down about $0.14 or 0.49% on the day. The market is live, and this thing is moving, having traded in a pretty wide range already today between $26.53 and $28.86, trying to find its footing after closing yesterday at $28.39. Now, seeing that intraday price of $28.25, you might just see another volatile fintech stock pulling back. But what most of the market seems to be forgetting is why it's volatile in the first place. This isn't random noise. This stock was trading at an all-time high of $32.70 just 2 days ago. That spike wasn't a fluke. It was a reaction to news that SoFi just became the first and only nationally chartered FDIC-insured bank in the United States to launch in-app cryptocurrency trading. Let me repeat that, not a brokerage, a bank. While competitors using platforms like Robinhood or other apps have offered crypto for years, they don't have a national bank charter. This is a completely different regulatory and structural ballgame. So the real question isn't, why is SoFi down 0.5% today? The real question is, why has the stock pulled back more than 13% from its high just 48 hours after announcing such a significant first-mover development? That's the disconnect, and that's where the real story is. The general expectation for SoFi has for years been flawed. Many investors still lump it in with the 2021 class of speculative fintech, thinking of it primarily as a student loan refinancing company. They see the SoFi Invest platform as a small-scale competitor to the giants, maybe a place for some self-investing, but not a serious threat to a Fidelity or a Schwab. They assume its growth is entirely dependent on macro factors like interest rates and student loan moratoriums. The narrative is that it's a maybe one-day company, fighting for scraps against Robinhood on one side and the established banks on the other. That expectation, however, is now dangerously out of date. The reality, confirmed by their recent earnings and this new crypto move, is that SoFi has already completed the transition that many thought was still years away. Let's look at the facts on the ground, because the recent trading activity tells this story of confusion. The stock has been on a tear. Let's be clear, it surged dramatically following its third-quarter earnings report on October 28th. That report was, by all accounts, a blockbuster. The company posted record net revenue of nearly $962 million, up 38% from the prior year. More importantly, it delivered record GAAP net income of $139 million. This wasn't some adjusted pro forma number. This was SoFi's 8th consecutive GAAP profitability quarter. They added a record 905,000 new members, bringing their total to 12.6 million. They also raised their full-year guidance across the board, projecting $1.035 billion in adjusted EBITDA for 2025. This is the kind of report you'd expect from a mature, high-growth company. But the most important number in that report was 56%. For the first time, 56% of their total revenue came from their non-lending segments, the financial services and technology platform businesses. That's the proof. The old expectation of SoFi being just a lender is factually incorrect. The company is now officially a diversified tech platform that also happens to have a highly profitable lending arm. Then, just as the market was digesting those massive earnings, SoFi made its crypto announcement on November 11th. The stock rocketed to that $32.70 high, and now we see this pullback. Why? This is where the cross-currents are hitting. First, this is profit-taking. A run like that from the low 20s to over $32 in a few weeks is going to attract sellers. Second, we're seeing some confusing institutional signals. Reports surfaced that Cathie Wood's ARK Invest sold some shares of SoFi alongside some Tesla stock. That kind of headline always spooks the retail market, even if it's a small part of a larger rebalancing. Third, and perhaps more technically damaging, was a filing from SoFi's CFO, Christopher Lapointe, indicating he had entered a prepaid variable forward contract on 500,000 of his shares. This is a complex hedging strategy, not a simple open market sale, but the market often interprets any filing from a C-suite executive involving their shares as a negative signal, a sign that perhaps he believes the stock is fully valued. This is the reality that is fighting the expectation. The fundamental news has never been better. Record earnings, raised guidance, and a first-in-the-nation product launch. But the short-term technicals and sentiment are being muddied by these institutional-level moves, creating this $28 battleground we're watching today. So, for those who are just tuning into the SoFi story, let's briefly establish what this company actually is, because it's not just an app. SoFi, which stands for Social Finance, is trying to be the one-stop shop for digital banking. It operates in three main segments. First is lending, the legacy business, personal loans, student loans, and home loans. This is their cash cow, and having a national bank charter means they can fund these loans with cheap, stable capital from their members' checking and savings deposits, which is a massive advantage. Second is the financial services segment. This is the app you see. It includes SoFi Invest, their online investing platform where you can do self-investing in stocks and ETFs alongside automated options, in similar concept to Schwab Intelligent Portfolios. This segment also includes SoFi Money, high-yield checking savings, and now SoFi Crypto. The goal here is to get members to use SoFi as their primary bank, and the cross-sell numbers from their Q3 report showing 40% of new products were sold to existing members prove it's working. The third segment, and the one many investors miss, is the technology platform. This is their B2B, business-to-business side, primarily composed of Galileo and Technisys. Galileo is a payments and card issuing processor. When other fintechs, and even some established banks, want to create their own debit card or banking app, many of them build it on top of SoFi's Galileo technology. This is their AWS for Fintech play, and it's a high-margin, sticky, non-lending revenue stream that now accounts for a huge part of that 56% majority. This is what truly separates SoFi from a company like Robinhood, which is almost entirely a consumer-facing brokerage. SoFi is building the infrastructure and the consumer brand at the same time. This is a much more complex and, if successful, much more durable model than many of its fintech peers, which is why comparing its online investment platform directly to a giant like Fidelity or a specialized trading platform like Interactive Brokers misses the point. SoFi isn't trying to be the best trading platform. It's trying to be the best financial home, where trading is just one feature in the ecosystem. Looking forward, the tension between expectation and reality will only get more intense. The new expectation, driven by the crypto launch, is that SoFi is now a crypto stock and will trade with the same volatility as Bitcoin or Ethereum. This is likely wrong. The reality is that this move is a calculated strategic risk. The macro environment for fintech has been brutal. As KPMG report showed earlier this year, fintech funding in the first half of 2025 was at its lowest point in 5 years. Investors are no longer throwing funds at anything that calls itself a neobank. The only two areas still attracting massive capital are AI enablement and, you guessed it, digital assets. SoFi, as a bank, launching a crypto product is a direct strategic move to capture interest and capital from one of the only hot sectors left. They are leveraging their bank charter, the very thing that cost them so much to get, as a competitive moat to do something its non-bank fintech rivals and its legacy bank rivals, who are too slow and scared of regulators, can't do. This sets up a fascinating future. The bull case is clear. SoFi continues to grow members, cross-sell products, and scale its high-margin tech platform. The bank charter keeps its funding costs low, and the crypto platform attracts millions of new active users who then get pulled into the broader SoFi ecosystem of loans, SoFi Invest, and checking accounts. They become the Fidelity or Schwab for the next generation. The bear case is equally clear: regulation. By being the first bank to do this, SoFi has painted a giant target on its back. If regulators decide to crack down on banks holding or facilitating crypto, SoFi will be the first one to get hit. Furthermore, while 56% of its revenue is now non-lending, 44% is still lending. If the economy tips into a severe recession, that loan book will suffer, regardless of how well the SoFi crypto or Galileo platforms are doing. This is the tightrope the stock is walking, and it explains today's hesitant price action perfectly. I'm curious what you all think about this specific move. Comment below if you think SoFi's launch of in-app crypto is the right strategy to differentiate itself, or if it's an unforced regulatory error that will cause problems down the line. Ultimately, we're watching a company in transition. The market's expectation is still catching up to the reality of what SoFi has become. The old story was about student loans. The new story, validated by the Q3 numbers, is about a diversified, profitable financial technology company. The next story, just beginning this week, is about how a nationally chartered bank will integrate digital assets into the core of its business.